So guys, what are we talking about tonight? Well, it's open Q&A. I've got 2 questions to start with, which I'll get into in a moment. But for you guys, try and keep the questions coming. I'll answer as many as I can over the course of the hour. Trading is all about psychology more than strategy. And it's about how you manage yourself, how you manage your account, and how you apply yourself to the markets. Any strategy will work. When it comes to particular strategies, if you want to know how GoldenEye works or how the river works, you would need to be in the squad to see that, to be fair to those guys. But other than that, it's pretty much an open table. Okay, so what I'm going to do is I'll start with the first 2 questions, and then that'll give time for the chat to come in, and then we can read through it, and off we trot. So if everybody's happy with that, we'll crack on. So it's a little salute to Bear Bull, Market Bull. I've just seen you snip in, and also Stephen, and I will get to that question, so don't worry. Now the first question, and I hope I really don't butcher this name, is by Ronox, and he asked, what's the difference between Fibonacci and a pivot? Right, okay, because I think where he may have got confused, I'm assuming it's a boy, by the way, so I do apologize, is I sometimes, when I have a fib on, I say there's the pivot. Right, let me just flick a screen over and I'll show you. If I just clean everything off. If I'm looking at a fib is just a ratio of 2 fixed points, which will be a definitive high and a definitive low. Just there. Definitive high, definitive low. Now, depending on how you're going to apply yourself to this, as to where those are. Well, here we can see the low. Now, you may just be working off this single overextended candle, or you're looking for a high point if you're sort of coming to market when it's down here somewhere. So you can see definitive high, definitive low. Get your fib as a retracement from the low to the high in the direction of the move, and your Fibonacci is these ratio numbers. Now, as you can see, if you scroll through, the market reacts heavily at these points because that's what they do. Fibonacci can find a ratio in a random set of numbers. So as you can see, there's the high, it's come down, stalled dead on the 23, came to 38, stalled dead on the 38, bang on the 50, get on the 61, 76, there's the low, and if we extend this through, what do we know? It is the 127. So the fib is a good map, and the pivot is the 50, okay, which is what sometimes you hear, because a pivot is exactly what it says it is. It's a pivot point where the market will oscillate around. Now, if I take that off and I put on a true pivot here, it's trying to do the same thing, but based on certain criteria. And the certain criteria it looks at, depending on which type of pivot you look at, is again based on a mathematical ratio. Now, the most common is on a daily, and it's the high, the low, the close divided by 3, which gives a set of ratios not so dissimilar to fib, but it gives a central point where it thinks the market is going to pivot one way or the other. And the rule of thumb is wherever the price opens, if it is below, it'll try and get to S1. If it opens above, it'll try and get to R1. And sure enough, opened below, went straight down into S1. Plot it. You'll see how many times. You can use combinations of them both, or you can just rely on one. It's just a good way of mapping charts out. Okay, so I hope that makes sense. And if you've just heard the big bang, it looks like Winky's just knocked something off the table upstairs. Oh dear, she's obviously had more than I have, but not to worry. Now, the next question comes from Greg. I'm not sure whether you can see that, but it's on here. Let me just read this out. Okay. Greg Mogg, and he's based in California, so he can't really make the Zoom calls we make on a morning. But I said I'd bring it up in this, or more to the point, he asked if he could bring this up. And this is a new member of the squad, and his question is about my levels. Now, he says he understands that I put my levels in on a Sunday when the markets are closed. And the question is, do I map out the trading arena in between the levels on the anchor chart, or do I wait till Monday morning? Right. What I do is I put all my levels into place. Okay. I like to do my primary markets on a weekend simply because the markets are shut. It means there's no noise or anything like that. And the levels are always high time frame. It's nothing below daily, right? So they're all in place. Now, when it comes to the anchor chart, when I'm looking to start going to trade, I don't particularly like to trade opens, and I don't particularly like to trade on Monday morning. Why? The markets are too unpredictable at that point. So when I'm looking at my anchor chart, and an anchor chart, for those of you who don't know, is a chart where you get your idea from. Now, for me, it's mostly the hour. So I look at an hourly chart, and it helps me do time frames. So top of each hour, check the chart. If I see, for argument's sake, like that fib that I just drew in, I can see a high and a low. That can give me, in fact, I'll put it on just to highlight what I'm talking about. So this is hypothetical. It's not time related or anything. It's just to give you an example. But say it's 9 o'clock and I see this, you know, say that's the 9 o'clock candle for argument's sake. And I've just seen this motion in the market. What I would do from that point is I would definitely be putting a fib onto it, just like so. And you'll often see on my chart what I call entry-exit zones. Now these will be interweaved into the solid support and resistance that I've already put in. And I'll put in a few parameters like so. Just like that. Okay. Now from here, what this has done, if I've got a trading arena, say there's a solid level up here and a solid level down there, and there's a decent gap between the two, well, that's an entry. So I can enter on this and I can be risk-free or sort of take profit at this point. And then at the 50, I can make a decision. I can be gone altogether, but I'll certainly take off a bit more profit. And then run it into 61 and so forth. So it's not set in stone how I do things. But once I've got my levels in place, I'll work an anchor chart each hour and those entry exits thereafter. But once I've marked up on a weekend, I don't change those levels. They're in for the entire week because I don't need to. They're all high time frame. So I hope that helps you there. Certainly do. Right, let's have a little look, see what's in the chat. See if there's any new people drifted in. So we've got Carl, Princey, Paul, Frederick. Frederick, what have you got me to do? You know, I wasn't going to do any prop again this year, but Frederick was twisting on, and well, he wasn't twisting on. I just felt like I needed to help him. So that's why I did what I did yesterday. So all the pain I'm going through, kid, is for you. Genuinely is. So remember, Scruffy likes a Star Wars figure. Right. And hello, John. How are you? We are all fine. Okay, let's segue back to Stephen's question. And the question is, I think I'd like to ask, what do you do when a trade is going against you? How do you know when to kill it? If we wait until the madness entry point? That's a great question. Let me just fire this on a second. We'll clean this off. Right. When you're coming into market, one of the hardest parts is that exact question, what Stephen's asking. How do you know when to kill it? Well, before you go into market, you should actually know what it is you're going to be doing in the first place. So let's have a little scenario, shall we? We've looked at this market. We can see it's surged up, tried to pull back, hasn't done very well. But let's have a little look to see where that move went from. So there's a fib, high to low. Okay, so where are we at? Put it on the highest point of that move, which is that red candle there. Okay, so you can see the start, see the end. I often tell you 50% is the pivot, segueing back to the start, and the market will often retrace to it. It will. Well, it went straight to the 50, showing it's not moving down, so the pivot's telling you to the upside, and then the market has screamed up. So at this point, you can be thinking to yourself, this is in an uptrend. Why? Surge, retracement, that didn't break 50%, carried on up, a lot of volume pushing the market up, lot of volume pushing the market up. So if you were to enter the market, say on this candle, just hypothetical, guys, remember this is just hypothetical. So you're deciding to yourself, right, I'm going to enter this market here, right? You've got a given entry point. You know where you are, right? But before that's triggered, you actually need to know where your pain threshold is. Well, your pain threshold can be the swing low, which is here. So you've got one swing here, one swing there, two. So at this point, you can say, right, if that market breaches that, that's enough. I cannot be prepared to take any more of that. So you've now got a space from there to there. You ask yourself a question. How much does that cost? First question you should ask yourself. If you don't think you can afford that trade, and I mean in monetary value, don't take it. Or leave your stop where it is and half your position size. Why? Because you need two barriers between you and the price. Now, at that point, you have this nicely marked out. So you can put your madnesses in space between the two lines. Simple. First three orders, 1, 2, 3, are your trade to go to whatever target you set up here. Okay? And you hold on to that. If it goes into 4, you start thinking I am wrong and it's damage control. And what you'll be doing is you'll be looking to use these retracements from 4 to get you out of trouble. And as soon as that thing turns net positive, you get out. That's simple. If it comes all the way down, which it did here, then could probably trigger 5 because you want a little space between your 5th order and the point where that's it, I've had enough. Again, when that swings back up, which it will because markets do oscillate all the time, you get out. But if you're wrong and it doesn't look back, you've already assigned your stop. And that stop has to be affordable. If it's not affordable, then you're going to sweat it. And if you're sweating it, then it doesn't become a trade anymore. It becomes a gamble. So I hope that kind of makes sense. So I'll just kind of recap that. Know where your entry is. Know where your exit is before you put any madness or averaging positions into it. And ask yourself, can I afford to pay this? And if you say yes, then that's fine. Then it's just a case of managing the trade out. When I put an average position in, I like to have them equally spaced apart. And the reason why they're equally spaced is the one at the bottom has to do the exact same amount of work as the one at the top to get to the middle. And if they get to the middle, you can cash out at what's called net positive. In other words, the bottom ones are paying the top ones off. But if they're not equal and they're all over the place, well, then it becomes really difficult to manage. So I hope that one kind of answers that, Stephen. I genuinely do. And if it doesn't make sense, just shout when we're sort of in the Discord, etc., and I'll try and make it a little bit more cleaner for you. Okay, let us go down. Frederick, thank you. You're very welcome, my kid. Romeo. Okay. Is fibs extension the same as a fib expansion? Because on my platform they don't have. Yeah, they're exactly the same. It's a set of ratios. I'll show you. So if I draw on a retracement, which is here, and I'll just sort of crunch this up a little bit so I can show it. What you can do is the retracement often has sort of these expansions here on the opposite side. You could just draw that in the opposite way if you haven't got one. So if I just get that and come off this and then just draw it the opposite direction, you'll see it's got the 127. But if I have an extension here, now my extension I use as a measuring tool rather than a retracement and an expansion. So just pull that backwards. There you go. They're exactly the same. And you'll notice I have 75, 50, 25 because I like to work in ratios. And I've got a retracement tool that tells me the Fibonacci ratios. And then I use this to space out. Nice and simple. So happy days, happy days. So nice and simple, easy question. So let's have a look, see where else we're up to. Okay. Hello, Damien. How are you doing, my kid? You're very welcome, Stephen. You're very welcome. So Grant, let's see. I see a few people on YouTube hedging. Do you ever hedge? Not really. I certainly won't hedge on the same product, but it's not uncommon for hedging two opposing products. You know, so you're going long on one, you're going short on the other. But I think you should be looking at a single asset at a time, and then look to work that asset correctly. What happens if you start hedging on the same product and you have some of it going long and then you think it's going against you, so you short it, you start getting yourself all muddled up. I find it quite a difficult concept to get into. But then if you're sort of hedging a product against a product, again, you lose your focus. You genuinely lose your focus. So what I have a tendency to try and do is I'll read the chart, I'll have my levels in place, I look for what I call the double D, which is the dominant direction. Now the dominant direction, well, it's going to come one part of the day. So instead of trying to go against it and then find it, I'll just be patient and try and time my entry a little bit better. And then that way I don't have to hedge. But then I'll know where the pain threshold is. And I had this out in an interview the other night and they really didn't get it. I know where the pain threshold is. I know where my entry is. And then I'll average backwards into it rather than hedge against it. And they're going, well, why would you do that? Why would you add into a losing trade? And like I said, it's not a losing trade. How do I know it's a losing trade? How many times have you hit the nail on the head when you enter the market? And the guy says, well, hardly ever. I says, right. So why not capitalize on it moving backwards? Because what you're going to do, you're going to put 100% into market and then let it run up to the stop. Well, that'll cost you more. Is it not common sense to go, well, I'll test it at this point and then work my way backwards, reducing exposure and increasing the upside profit? So that's my form of hedging. Genuinely is. Okay. So, yeah, it is great. It is weird. The problem with trading is It is the most argumentative industry there is. It genuinely is. And because money's involved, it expands that massively. There's only one measuring stick in trading, just one. And I'll say this, the cows come home and I don't give a toss what anybody thinks. The measuring stick is whether you get paid at the end of the week. Doesn't matter what happens in the process. You can have the weirdest system on the planet as long as it works. If it works, you're right. If it doesn't work, you're wrong. That's it. That's the measuring stick of trade. But people don't understand that. They think, no, it has to be trend following. It has to be this. It has to be the other. Bollocks. If it works, it works. End of. Simple as that. So there we go. Alphonse, welcome to the squad, my kid. Welcome to the squad. We're back at it tomorrow. We'll be having a jolly old time of things. Okay, Stephen, let's see. You don't trade on the UK Open first hour. So would you wait for an hour? I wait about half an hour on the US Open. I'll kind of explain that one. On a Monday morning, the market goes haywire, and it's pretty much a gamble on a Monday morning. And if you hit lucky, that's pretty much all you're doing. You're hitting lucky. The London Open at 8 o'clock is the same scenario. That's when big money's starting to come in. But not only is it big money coming in, you've got the close of Asian session. You've got the Europeans starting to wake up. Then you've got the money flow coming in, because whether we like it or not, London is one of the main financial hubs of the world. So all of the big players are setting up in and around 8 o'clock. We don't know what they're going to be doing. In fact, we haven't got a clue. So we have to wait to see what breadcrumbs they leave behind. Now, that's going to take about half an hour, because the orders are going in, and you'll often see the market will go one way before it goes the right way. What they're doing is they're inducing your orders into the market while they're placing their orders. They're basically playing a game of chess, and they're better than you. They're certainly better than me. So my theory is very simple. I ain't playing with them. I'll step out of it. Then I'll see what's going on and I'll trade it. Now, later on in the day, Stephen's exactly right about the US Open. The US Open, again, is going to be haywire, but it's not as violent as the London Open because it's only one session at that point, and we pretty much best way through London. So the money flow isn't as violent. So what I have a tendency to do there is I kind of stay away from the Open for about half an hour, but I trade top of each hour anyway, so it doesn't bother me to sort of go, right, well, is the market ready at 1 o'clock? No. Is the market ready at 2 o'clock? No. Right, I'll wait till 3 o'clock. But a lot of the time I'm done by then anyway. I'm normally finished around 12, 1 o'clock. Unless, of course, Finney opens his big gob, which he often does. And it's the only thing that's big on him, boys and girls, because he's a little hobbit. He's only this big. No. But the guys in the group, they'll often, how do you do this? What do you think of that? And I feel on a bound to do it. I'm one of these that, how do I put this? I might get slagged off all the time, but at least I back up what I'm saying. All the time. I'll put my head on the block. If I say it, I'll do it. And if I have done it, I'll prove it. And that's what I've done all the time. So when people have a pop now and they say, I want to say this, and I want to say the other, I just tell them to sod off because I've got nothing else to prove. I've done this for years, day in, day out, as you've seen. That's my thought. I almost got on one today. Because I've had a shit weekend. I really have. But there we go. So where are we up to? Andrew. Hello, Andrew. How are you doing? Agreed with what's on the whiteboard. On the whiteboard. Oh, yeah. Bang on. So, I've been naughty this weekend. Okay. David, how much would you need to trade without leverage? That's a question. Really depends on the asset you're trading. Leverage is buying power. And under ESMA law and rules, depending on what it is, it's up to about 1 in 30 now. So it's pretty tight. You get away with it with around 10 grand, I would have thought. But it really depends on how much your expectation is. Personally, if you want to earn a wage, you need around 5 grand, but then you need the leverage on it, which would be sort of 1 in 30. If you're starting to leverage up constantly, and this is a big argument everybody has, oh, I need to leverage up, I need to get my position size up. Why? The position size won't take the account, or the account won't take the position size. So all you're being's an idiot. You know, you want to be trading with the smallest position possible against your account. You know, I can go up to 25 quid a point, which is pretty good, but I've got a big account and it took me years to build it. I can do 2.5 grand against me and it doesn't dent the account, not much. But if I've got 10,000 account and I take the same position, which I could technically open them up, and I do see it, where I see guys, they put big positions on, but I know the size of the account and I know the size of the drawdown if it's prop, and all I'm looking at is thinking that's an accident waiting to happen because it's way too big. You know, think about it, 2.5 grand against 10 grand. So it's going to take long to wipe that 10k out. Put it into 100,000, well, then you've got a chance, haven't you? Common sense. Common sense is what you need to be applying when it comes to trading. Sorry, almost got on one. So, Richard, how are you, my friend? Let's have a little look. How many pips do you let the market move against you every time when you're scaling it? Well, that's an interesting question because markets are not fixed. They're genuinely not. So, pips doesn't really worry me. Money worries me. Let me flick this back over and I'll kind of give you an example. I work on hourly charts, as you say, and we were looking at this kind of simple equation. Said, right, we're going to enter there. I can see a swing, which I know the market will test. And if you look at these things, they do it all the time. There's a swing. There's a swing. What happened on that? Market went for me, came back down, tested that, probed, and then wallop away. If I was doing tight stops on the first point of resistance, I know I'm going to get stopped out every time. You know, and how do I know? Because I've been through it. You know, I call it death by 1,000 cuts. So I'm not frightened of a wide stop, but there's a difference between a wide stop and a stupid stop. So that's why I ask a question. So in this equation, if we just have a quick look at, there's a swing, there's a swing, 2 barriers. All I need to do is just measure the distance. Okay. So in that case, it's 70 pips. A lot of people be frightened of that. We go, I'm not doing 70 pips. That's ludicrous. Really? Well, the market swings like that all the time. And if it's on the DAX, it'll do it in an hour. It's not out of the ordinary. So never be worried about the pip. A stop has to be where a stop has to be, and it has to be hidden behind something that is structural. Now, this can be a Bollinger Band, it can be a moving average, it can be a level. So in this equation, I would look at that and I'll say, how much is that going to cost? Not how many pips is involved, but the cost. Now, let's just say that was 130 pips. Well, to me, that would be too costly. But 70 pips, £1 a pip, 70 quid. It's not the end of the world. Right? If it goes beyond that, well, I don't want to pay any more than that. So that's the way I look at it. I work in money. That's why I don't care about percentages, don't care about risk reward, none of it. Because, well, right, I'll kind of explain that as well, because I got pulled on that the other day. Say, oh no, you've got to have 3 units for every one. Bollocks, dear. Think about it logically. If that's the case, then the market has 3 times more opportunity to take the money off you than it has to give you. Is it not more common sense to start in the middle? So 70 pips that way, 70 pips that way, 1 to 1. But I don't want to pay 1 to 1. So I'll reduce the exposure going back. And then if it hits target and it does move all the way to the other side, that third position has so much further to go. It naturally excuse me, got a frog in my throat. Obviously I haven't had any beer, so I'll have a quick drink. Thank you very much. It naturally increases the upside. And because it naturally increases the upside, it gives you a greater rate of return. Give us a second. I might actually have something that I can show you. Drop your questions in, and I'll try and put this into perspective. Madness. Right, here we go. Give us a tick. I think you should all be able to see a quick spreadsheet here. Right. Let's just say we're on £5 a point. We're going to target 50 with a stop of 50. Okay? That's what we're looking at. So the investment, if I just take out the first position, at this point is 90. Now if I put the same on this side over here, okay, 5, right, 2 to 1, so that's risking 250 straight away. Target of 100 gives you 500, right? I get that. That's about as simple as it gets. The problem with it is it's all or nothing. If you break your position up, you have room to move. Now, that's 1 to 1. Now, I could set the target the same, but I'm going to leave it as is, just so that I can highlight something. £5 a point, okay? Here, we've hardly got anything on the table, 90 quid, but we're getting a profit of 110, which is 1.2 on 2 positions of only 2 quid. Right. I put 3 positions into the equation. I've got less than half of what's over here, but my profit's racking up and it's giving me a 1.5 return. But if I chicken out, I still get 30 quid. Now, let's just say I'm really confident this is all going to target. And it triggers the 4th because it can move that far and then come back. I've got a 1.9 return, but minimal investment. And this is the bit that I keep an eye on. I'm looking at how much I invest into the market. And if it runs and I get all 5 triggered, it'll give me a 2.3 return. I can chicken out, still make money. But look how much I've invested. Next to nothing compared to this. So I can make money off that. Whereas this, it's all or nothing. I have to hit it the nail on the head. And if I don't, well, I lose 250. Here, if I lose 150. So I'm still in the game. Money can destroy the account. Process is king. Hope that one kind of makes sense. I genuinely do. So where we are. So I'm normally out by, yeah. The thing is, another good thing, Stephen, is once you're paid, walk. You know, if you keep trying to go back to the market, eventually the market will catch you out. And when it catches you out, that's when you sort of go into revenge trading, all of this, and all the good work you've done, it's not there anymore. You've given it all away. So happy days. So what's this? 100% everyone is different. Correct, my friend. We are all different. As long as it works for you, it's fine. And that's it. I mean, people look at the way I trade and they go, oh, whoa, whoa, whoa. But trading's simple. Get your levels into place. If you know what they are, you're laughing. If you know what your main direction you're looking for, again, you're laughing. The level will give you a point of entry. The direction will tell you roughly whether it's good, bad, or indifferent. And you can do that just by looking at basic stuff. A Bollinger Band. Is it flaring out? Is it underneath the moving average? All of this sort of thing. And then just target appropriately. And your maximum target can be the next resistance point, whether it be a level, out of Bollinger, whatever. Simple stuff. Simple stuff. Okay. Finn, I'm not small when it comes to beer. Yeah, you're right, you're not. He's a right pot. Anyway, I thought you were on the wagon. Thought you'd fell off. Have you fell off, Finny? Oh, go on, big balls. Tell me that you're back on the beer. I'll come back down to Manchester. I'm not coming down for a glass of water. You can bugger that, lark. But if we're having a beer, I'll come down. So, happy days. Hendrik, don't worry. We're still rabbling on. We were just sort of killing time till you got here, my friend. Okay. The DAX can be brutal. You are not kidding, the DAX can be brutal. The DAX is one of those markets that if you get it wrong, you really get it wrong. And that's why it's very, very important to have an entry and an exit before you press the button and agree to that exit. If you do, and this is another thing, I'm often said, oh, you're too calm when you're trading. Well, there's a number of things behind that. Because one, I've done this a very long time, and when you're just starting out, your emotional dial's sort of 9 and 10. I've done this that long. My emotional dial's down to sort of maybe 2 and 1. I don't get frightened. I just follow a process. But the DAX can certainly get the heart going. It certainly can. And that's why you have to say, can I afford this? And if you say no, half the position size. If you still say no, half the position size. And if you still say no, think, well, should I be taking this trade in the first place? And that's kind of how you control the DAX. So, happy days. So, Mohammed, hello. Let's have a look. Any tips for passing the 250k boot camp? Well, the way to pass prop is very simple. One, don't chase the dragon. And the dragon's the big money. You want to break down the amount of money that you have into a tiny daily chunk and then times it, sort of divide it by 2. So if you, the one that I was looking at and I opened up yesterday is instant. I kind of work on halfway into the challenge and how much I need to do per day to get there. That allows me a little bit of recovery time, but it also gives me a point of stop when I'm on the charts. So I worked out that I need to do about $6, and $6 each day will have it passed in about half the time. Yeah. And if it goes a little bit over, so maybe I do $7 a day or $8, well, it all adds a little bit off the end. But what I'm trying not to do is swing for the fences. And then I broke down that daily position into how many pips I need to achieve it. Now, I know I can find 10 pips relatively easy, and I like to trade once or twice a day. So I'm working on 20 pips a day to achieve $6. Simple. So I've got an expectation that's achievable, and the target will just look after itself. And that's how you pass these boot camps. But then once you've passed the boot camp, you then need to look at the milestone for the next set of money. And you do the same thing. You say, right, I want to pass this milestone in 3 months, or I want to pass it in 6 months. Work out what that is over 6 months and do the same process. But one of the worst things can happen, and I've seen it, is you get funded and you go, right, got this big account now, I'm going to whack the position size up because I'm going to get paid a fortune. And you find that you lose a fortune because it don't work like that. Small is best up there. Unless, of course, it's something else. Not allowed to say that. Winky says I'm naughty. Says I have to behave all the time. And it's not going to happen, boys and girls. It's not going to happen. Okay, so let's have a look. Grant, on my broker, the the D40 and its lot size. How many pips in a lot? I don't work out in pips. I adjust lot size to the stop I want. Right. To be honest, off the top of my head, I don't actually know. I think it's about, it works in points on MT5, and it's roughly 1,000 a pip. Is it 1,000 a pip? Something like that. It's 100 for 10 pips, so it's 10 points. So it'll be, no, it's 100. It's 100 a pip. I wouldn't change my lot size. I genuinely wouldn't. That's the road to ruin as well. We're just discussing on the boot camp. If you're doing mathematical gymnastics all the time, going, well, my stop's here, and then I can increase my lot size to that, you'll just blow the account up. You'll blow it all the time, because what happens is you haven't got any set ratios to work with. The amount of money you have changes from trade to trade, so there's never a pattern. You're better off sticking with a single lot size based on your account size, not based on the pips or what you think you'll get out of the market. You know, it breeds gambling as well if you're changing your lot size, because you might hit a big winner with a full lot on, sort of 10 quid a point, and you'll think, brilliant, they're all going to be like this, but the next one just lacerates you. Whereas the account probably could have only take £5, which is half a lot. Now, I have a simple way of working this out. I work on £1,000, or if I haven't got £1,000 account, 50p for 500. What that does is that calms everything down, and it makes life easy. So in lot terms, if you've got £1,000 account, you're allowed £1. That's your biggest position size. So that would be 0.1. If you're under 500, the maximum I will be putting on is 0.05, which equates to about 50 pence. But keep your lot size in relation to your account size, rather than what you think you're going to get out of the market. You'll find that you'll make a lot more money. You'll be a damn sight calmer in the markets, and the process comes a lot easier. Saves you trying to do sort of gymnastics, and by the time you've worked it out, the trade probably ran off anyway. So there we go. Happy days. Yes, I use madness every day. It's a good way to build a position, and as Ivan's just said, get you out of trouble. Only because they won the World Cup. Who cares? So, I'm not a big fan of football, boys and girls. I'm really not. Golf's my game, and sort of being a tit, I suppose. I like to be an ass, but there you go. Okay, you're a bit late, Fugly. Don't worry. We're just killing time till you got here. Okay, Mohammed. So I work full time. So I've been trading for our time frames because of my schedule. I'm thinking long term, trying to hit the target of 1.5 month. What do you think of it? There's nothing wrong with what you're trying to achieve. You can trade any time, and if you're working around a day job, looking at longer time frame charts is more ideal. You're certainly working full time. A 4-hour chart is a great one to look at, so you can get a feel of what the market's going at, because it's at a slower pace. And then from the 4-hour, you can drill into an hour to fine tune an entry and use a pending order. And then all you need to do is just, if it's 1.5 a month you're looking for, work that out against your position, your account size. That'll give you a monetary figure. Divide that monetary figure by the working days. That'll give you a daily target. Work out what your average pip win is, whether it's 10 pips, 20 pips, you might even get 40 pips, whatever it is. That'll give you the position size, and then just work methodically like that, and then you'll be fine. Finney, thing with Langers is he's an idiot. No. Sorry, Finney, I was putting words in your mouth. Everyone's their own best teacher. Correct. You are so true. Trading is more about mindset than anything else. It's the hardest concept to get across because everybody thinks it's strategy and there's a magic key. And if you only have the keys to get into the secret room, you're going to be rich. That's your first failure. Every single strategy works. Every one of them. The difference is knowing when to use it. Reading a chart and understanding conditions is more important. Because if you're using oscillators in a trending environment, it's not going to work. But if you're using moving averages in a trending environment, it is going to work. The difference is knowing when to use each. It's that simple. I find levels work because it doesn't matter what type of market it's in, the market will naturally gravitate to levels. I've then just got to figure out which one I'm going to use to enter and which one I'm going to use to exit. It's that simple. That's why I sometimes refer to the markets as day trading, market neutral. I'm prepared to go both ways, but I'll only ever trade a single direction in a day based on the one that I think is the strongest. It makes life a lot simpler. So that's why you're the best teacher, because only you know your pain. There's only you know what you like, and then you build on that. Simple. You might be able to recognize a range, so you're naturally a good range-bound trader. You might naturally like longer term charts and you can see trends, so you want to move with the trend. Really depends on your personality. And your personality will guide the type of trader you are. The strategy won't. So there we go. Happy days. Try to adjust so my max loss, as long as it's in relation to the account size, there's nothing wrong with having a max loss. And that's why I say ask if you can afford this trade before you take it. But what I will say is if you're trying to pick tops and bottoms of markets, it's very difficult. And that's why tight stops just don't work. Because how many times have you gone and looked at a market and thought, this can't go any further? This surely can't go any further down. And then sure enough, it does. So is it not better to work in the middle of a range? Because we're not going to get the bottom third, we're not going to get top third, but we will get the bit in the middle. Let the chart show its hand. Happy days, happy days. Hello, Black Tigers. Little salute to you. Steve O, got it yesterday. Superb, my friend. Right, hello. Do you know, how can I connect one account to 10 others when I trade my account and I trade, what? Let me read that one again. How can I connect one account to 10 others when I trade in my account? The trade spread to others automatically the same. Right, I'm assuming you're talking about copy trading. There's plenty of copy software out there. Personally, I don't use any. I use multiple accounts, but my day trading wage account is a single account. I will manually copy into a prop because it's very easy for me to have two screens sitting side by side. And then my other accounts are all end of day on daily charts. And I can just quickly put pending orders in. But what I would say, and I've seen this question being asked before, where somebody's trying to do arbitrage against prop funds. In other words, they have various prop funds, and what they want to do is just copy one trade into 10 of them. The danger with that is if you screw one, you screw them all. I prefer to, yes, I have multiple accounts, but I never trade the same asset in the other accounts. My day trades, sort of my wage account, my prop, I do, because I haven't got time to sort of flick around. But when I'm trading my car account, my house account, my holiday account, I trade different assets in each, so it spreads out the investment. And if I'm wrong on one, it doesn't screw the other two up. I hope that kind of makes sense. It's kind of lessening the load, shall we say. And again, it segues to the back side of this conversation, where we're talking strategy and one thing and another. I said the management of your account is what makes you money. That's how I do it. I spread out the investment, so I'm never fully exposed at anything. And if something does go wrong, it doesn't cripple something else. And that something else can make enough money to clear off anything that I've done wrong elsewhere. Simple stuff. Okay. Wes, salute to you. Did your experience in running your own business give you a jump start? Yeah, it did. Well, I'll take this right back. My business career started in sort of my mid to late 20s when I was put through business school. I worked for a pharmaceutical company. Now, in that medical company, by nature, we deal with big numbers. So big numbers never frightened me. You know, I was used to dealing with them all the time. And it was also an incredibly hard, high-pressure job that I had. And then when I sort of decided that I'm not going to work for the man for the next 20-odd years, because when I was coming on to my 30th birthday, I thought, screw this. I can't do this for the next 25 years, you know. I want to do it my own way. And I started a business which was very small, which over the years grew to be very big. And you are right. Sometimes you don't have a paycheck. For the last year of its business before it closed, I didn't get paid at all. Nothing. I gave everything back to the business, and I ensured my staff were always paid before I was. Now, from a psychology point of view, it hardens you. You get used to it. But it also gives you the point of view that you understand that it's feast and famine all the time. And you always have to have reserves in order for the time when it's lean. In other words, when it's famine and there's nothing there, you need something in the background that can ensure that you are fed. Business teaches you that, teaches you the hard way. Whereas if you've got the safety net of somebody paying your wage at the end of every month, not so much. And it's why most people don't get trading, because they don't understand that it is a business and it has to be treated as a business. And that means you've got to plan it. You've got to plan for the bad times as well as the good times. And that's it. So yeah, the business certainly did. But on the other point of view, trading was part of my business. So I kind of had a heads up before I started doing it as my sole income. I understood what it can give, and I understood what the limitations of it were as well. I didn't come into this wide-eyed thinking, oh, I've seen a YouTube video, I'm going to make a fortune. No, it was just a job that I knew I could do. And the only thing that I needed was the money. Now, at the time, I didn't have the money because I lost everything overnight pretty much when the company closed. I had to build it up, and it took a long time to build that up. You know, had it reasonably okay in about 18 months, but it took about 3 years to get it to a point where I could take some risks with my trades. I could start drawing decent money out of it. And then here we are 6-7 years later, it's paying me very well, you know. But think of it this way, guys. If you're doing an apprenticeship, we're not paid very much in the first couple of years, but you still have to work bloody hard. I certainly did, sort of, when I was 18 and I was doing it. If you got £5 a day out trading off a £500 account, that is a massive return. It is wonderful, but you'll scoff at it. And I've had people scoff at it, you know, but that's 25 quid a week. If it's a 4-week month, it's £100 a month. You're going to screw up. So you want a month's worth of recovery. You want some holiday because you're not going to trade all the time. You're going to have Christmas off, that sort of thing. So work it on 10 months. It's £1,000. Well, next year, you're not starting with 500 quid. You're starting with 1,500. Do the exact same thing. And you're going to end the year with 3 grand. So you can start the year after with 4.5. Then it's starting to pay you. That's trading. It's slow, steady growth. But if you're chasing the big money, just give it up. Just give it up, because you're not going to get it. You know, you might have some good winners, but I'll guarantee the losers will take it off you. But if you go steady, you'll be fine. So where we are. So there's psychology for you, Wes. Right, so where are we at? Bert, hello. Not sure what that means. I bet the bud's as warm as a brew. I actually need... Well, it's actually quite cold, actually. It was in the fridge a long time, but I'm going to have a beer anyway, so... I'm the big bear, you know that. It's that one. That's what you need, not Coors, not Carlin. You need a bud. Black sheep. You crawl back under your tractor, redneck. Okay. In case you want to buy me a beer. Actually, in June, I'll be in London, and I'm coming down for a few days, Stephen. I'm doing that talk on the 17th, so I'll be in central London for a few days in and around that time. So we'll have a bit of a scruffy, mate. We'll do that. Guinness, get over yourself, Ivan, will you? I know you chuck bloody axes and everything, but bloody hell. Chemical mug. Bloody hell. See, they're picking on me now, boys and girls. They're picking on me again, but I'm still going to enjoy it. Who cares? Right, Fugly. Are pips the same in Forex? Right. I'm not big into crypto, and you'll hear a lot of... To me, you've got pips, ticks, points, whatever you want to call them. It's just a price movement. That's all it is. Just a movement of price. And different platforms have it laid out in different ways. So I wouldn't really get too hung up on it, Fugly. As long as you know that if it moves from 9 to 10 as two price levels, if you like, and the cost of that is X, that's the price per movement. And then that way it'll calm you down, and you stop trying to dig too much into it. For me, I just look for it to move from X to X, and that's it. So I know 10 points is about 1 pip. But if you go onto the MT5 platform, it just gets a bit wild. It really does. And again, that's why I go back to money. I always think, well, how much does this cost? So I can drag it up. And I'll say, right, that order is going to cost me X amount of money if it hits the stop. And if it hits my target, it'll make me X amount of money. Then I'm happy. I'd boil it down to the simplest form possible. Happy days. Happy days. Oh, yeah. Oh, you're coming to the talk. Fantastic. There's quite a few of the squad coming. So it'll be great to catch up. And I think everybody should bring their dolls with them. That would be an absolute hoot. If everybody's sitting in the auditorium, they've all got their little dolls with them. I'd really love to see the face of some of the other speakers. Well, maybe not. Okay. So is there any more questions? Because we're coming on to the top of the hour. And yes, Vinny, my beer's getting a little bit warm. I need to sort that out and get another one. But if you've got another question, now's the time to fire. Otherwise, we'll wrap this up a little bit. Steady does it. Never. Let's be honest. Always live your life, Bert. Always live your life. And there's nothing wrong with living it in excess as long as it doesn't affect somebody else. That's my motto in life. And well, the other motto is live every day as if it's your last. And one day you'll be right. Well, they'll certainly break something. I don't think some people get my sense of humour at times. Not to worry. Okay, no more questions. So we'll wind this up. Yes, for those of you who are not in the squad, what Steve was referring to is every morning we have a face-to-face Zoom meeting. We have a little chat, set ourselves up for the day. Within it, there's a different subject each day. It's Markup Monday, where we'll mark a chart up and we'll talk through it. Troublesome Tuesday, areas where you sort of get yourself into trouble, how to get out of it, that sort of thing. Winning Wednesday, same thing, but in reverse for winning. Thoughtful Thursday, it's where we talk our mindset and how to control our emotions. And then Free for All Friday, which is just an open Q&A and a chat amongst ourselves. So, very good. And if you're not part of the squad, do come along and join us. The guys will make you incredibly welcome. So is that it? We good? Happy days. Okay, boys and girls, have yourselves a great one. Be careful of your opens. Always watch out for news. If there's a news event coming, my advice is just stay away from it till it's happened, then trade the aftermath. Much safer. So have a great one. See you all soon, guys.